All three major averages reversed strong midday gains after Minnesota Fed President Neel Kashkari suggested the Fed may not cut interest rates at all this year if inflation progress stalls. For more on the latest moves, let's welcome in Steve Sosnick, Interactive Brokers Chief Strategist. Steve, always good to see you. So help us think through this, Steve. So stocks trading lower here. Do we blame, Neel Kashkari? Julie pointing out he's not a voting member.
Well, Josh, I think part of it is we were rallying because of optimism that Powell, was holding out the carrot. It really is almost like a carrot and stick kind of thing of rate cuts this year. But Kashkari pushed back on it, and Powell didn't even say anything different in his most recent speech. He's actually had a very consistent message. It's not really what he says, it's what the market chooses to hear. I've sort of been along the lines of Kashkari and Raphael Bostic, and I believe Lisa Cook, who've sort of been questioning the idea of, maybe do we need any, maybe one rate cut here and there. And I think I tend to agree with them because it's not clear that we've got mission accomplished on inflation. It is quite clear that we've got plenty of money flowing into speculative assets. And it's not, and so that it may be premature to be holding out the idea of rate cuts right now.
Okay, and yet, as we have pushed back the number of rate cuts and the timing of rate cuts this year, equities have performed quite well, in part because it's being pushed back because the economy seems to be still growing at a decent pace. Okay, so if there are no rate cuts this year, and it's still for that reason, can equities still perform okay?
Yes, the economy, because you hit the nail on the head, Julie. If we're not getting rate cuts because the economy is good, I'll take good economy over rate cuts any time. That was the question we came into as the year started, and I'm actually amazed that the market answered it so painlessly, was how do we get both a soft landing and 6 or 7 rate cuts? Because they're not they're not happening together. Well, we sort of seamlessly took out the idea of the rate cuts, which is fine if it's because of the strong economy. But then if you start to throw in some economic worries, if you start to throw in oil price pressures, well, that sort of sounds a little more stagflationary. It ties the Fed's hands without necessarily getting the economic boost. That's not necessarily the scenario wants to hear. We're a ways away from that right now, but I think we're seeing a little defensiveness ahead of the jobs numbers tomorrow. And after having a rip-roaring end to the third quarter, we're getting a little hangover this week.
Steve, you point out kind of the risks of cutting. What about the folks who say, listen, the risks of not cutting as well? And you know that argument. You're too high for too long. You might break something.
Oh, absolutely. There's no question about that. We certainly do have to see a strong economy to justify it, and the numbers are mixed. Every day, you get a good day one day and a bad number the next day. We'll find out tomorrow whether the job market is healthy. It's important to keep the dual mandate in mind. Stable prices, closer, but not there yet. And Powell is quite among all of them acknowledging that we're not quite there yet. Things are getting better. But full employment, we're still pretty much there. I mean, yes, we ticked up to 3.9% on the unemployment. Tomorrow, we're expected to see a 3.8 tick. But anything that starts with a 3 pretty much sounds like full employment. I guess the third leg of the dual mandate, as it were, was sort of healthy credit markets and a stable banking system. But certainly, we're not seeing any of those stresses come to light. The Fed would know more about that than any of us would, because they're privy to stuff that we don't get to see. But clearly, with the amount of money going to some of the most risky endeavors, it's clear that people are not really holding back on extending credit or spending money throughout the economy.
I want to talk a little bit more about the jobs report tomorrow, because I'm curious how you're gaming that out. I mean, Powell has sort of tried to de-emphasize labor market readings. It seems like they're sort of weighting the inflation readings more heavily right now. He doesn't seem as concerned about the job market. So how do you think the market kind of reacts then?
Well, I think he's right to sort of to focus more on the stable, the prices, the inflation, because as I said, it's if you've got a dual mandate and you can check the box on one of them, you're gonna want people to focus on the part where you haven't been able to check the box. So gaming out tomorrow's number, I think we're fine if the number comes out around in line. As long as everything is more or less as expected, and I'm not going to, plus or minus, I can't really say plus or minus this or plus or minus that, but if the general reading is around as expected, you're probably okay. Too hot or too cold can be problematic. Too hot well, you're not getting rate cuts anytime soon. Too cold, you go back to Josh's question of, wait a minute, maybe we really need these things and they're holding off.
And Steve, another potential catalyst, earnings season. We're creeping up on it, a couple weeks out. What are your expectations there?
Well, this is really the thing. Last quarter, I think we were sort of surprised at how well the market did, because we came in with high expectations and for the most part exceeded them and got good guidance. We've ratcheted it up a little bit more over the past 3 months. And so I think coming in, my fear right now, when you come into earnings season as a high, near a high, which we're awfully close to, there's a lot of good news priced in. So my concern going forward is that, are we able to beat the raised bar that we've set for ourselves? Because some companies have been able to do it. I mean, you look at an NVIDIA, which is remarkably good at beating and raising and then beating again. Most companies can't do that, and I do think there's a certain amount of that is priced in, particularly in the more high-flying stocks.
I want to circle back around to oil prices also, and just talk a little bit more about how much of a concern that is for you and for the street.
One of the first lessons I was taught, and this kind of shows my age a little bit, was always be nervous when you see oil stocks lead the rally, because that's never really a good sign, because that means oil prices are going up, and that means inflation is out there lurking. I wrote a piece today, ibkrcampus.com, about how I started to, how it looks as though we might be seeing a double bottom forming in the price of crude, and how XLE, among other measures of energy stocks, has been a terrific performer. And in the last 3 weeks or so, energy has been outperforming SPX. That's not like this big waving red flag, but it's something to be concerned about, because Powell keeps harping on inflationary expectations. Inflation expectations are very closely tied to the price at the pump. The Michigan one-year employment statistic for expectations is basically like a 1 month lag of gas prices, 1 to 2 month lag of gas prices. So we haven't really seen the prices accelerate at the pump too much. That's why those have been relatively quiet. But if energy prices stay high, the Fed, on one hand, they want to ignore in the PCE, they want the core deflator, which excludes volatile food and energy. Except that inflationary expectations among individuals are very heavily tied to the prices of food and energy, because those are the things they spend the most on a regular basis. So it's a tough conundrum.
Yeah. Seasonality too, top of mind, Steve, sell in May and go away. You think that applies this year?
I think it's a risk. Seasonality is never perfect, although I will say the rally literally started on November 1st. So that's definitely a consideration. This year also, it does start to coincide actually with tax season to a certain extent. A lot of people have a lot of gains over the last year. Will people need to sell stocks to be able to pay the taxes that on some of the gains they've made, or have they been holding back? We'll find that out. That's a lot of where the seasonality comes from. So you throw in April 15th along with earnings season, along with a calendar that's held very tightly to the seasonal biases. It's something that I think you have to be, if not heading for the hills, you have to think a little more defensively than you've been thinking over the last few months, where it's behooved everybody to play offense and play offense heavily.
Steve, finally, I want to ask about big tech briefly, because we were watching some of big tech rally earlier today. Some of them are still up. Meta is still higher right now. Tesla, which was rebounding earlier, still, I think, has been hanging on to some gains, but Nvidia's lower. So I'm just curious how you're thinking about big tech right now and whether people should be still looking to add at these levels.
We've been the beneficiaries of this huge momentum trade. And again, a lot of it is for good reasons. A lot of the companies that have led this rally have been delivering on the top and the bottom line, which is what you want to see. Can that continue indefinitely? That's a tall order. And we've started to see a little more, I'm going to call it discrimination within the tech sector. The Magnificent Seven is not a Magnificent Seven anymore. It's a Magnificent 3.5 kind of. Microsoft is sort of moves along with the market, but Apple.
It's not as catchy, Steve. I have
to
say.
I could call it the Fantastic Four. That worked. That worked for Marvel Comics for many years. I'll throw Microsoft back in there. But Tesla's got its own set of problems. Apple, I think the market is re-rating as a value stock instead of a growth stock, because honestly, its revenues are not really growing particularly fast. And so, you've got some push and pull in there, and I think that's why earnings season becomes so important, because we'll really be able to distinguish who's winning, who's losing, and who's hype, because I do think there's a lot of other companies that have been benefiting sort of from the AI hype, but not necessarily translating it into a bottom line, and we'll find that out in the weeks to come.
Yeah, when we start to get those earnings. Thanks so much, Steve. Great
My
to
pleasure,
see you.
Julie.
I'm so
Thank you.
glad you were here today as we were trying to make sense of all of this. I
Thank you.
appreciate it.